Good morning, good afternoon, and good evening, everyone, and welcome to the third and final day of our IAIS Global Seminar. Today, we will hear from the chairs of three of the IAIS committees about the work that they've done so far this year to date and plans for the rest of the year. First, we will hear from Dieter Hendricks, Chair of the Macroprudential Committee. Then we'll hear from Matt Walker, Chair of our Policy Development Committee, and last but not least, from Peter Braumüller, Chair of our Implementation and Assessment Committee. Today's session is in a new format that we're using to increase our engagement in response to your feedback. So the committee chairs will start with about a 10-minute introduction to what's been happening in the committees, and then we will allow for about 20 minutes of question and answers following each of these presentations. So we'll get into that now, but before we do so, let me kick off by providing a little bit of context on what are the core elements of our work program, and reminding everyone this should be a familiar picture of what those core elements are. So starting at the top of the screen there, you'll see really the starting point for much of our work is the global risk assessment that we undertake, contributing to the maintenance of financial stability, but also trying to understand some of the emerging developing risks and trends in the global insurance sector, which we do largely through our annual global monitoring exercise. This then helps feed into both our standard setting work and our work on supervisory practices. As you know, the last few years have been a very intensive period of standard setting, finalizing key post-crisis reforms such as the holistic framework for the assessment and mitigation of systemic risk in the insurance sector, or the holistic framework for short, that we finalized in 2019, and now the Insurance Capital Standard, or ICS, the quantitative element of the common framework for the supervision of internationally active insurance groups, due for adoption in December this year. At the bottom of your screen, you'll see the third key element of our work is about addressing risks and opportunities of accelerating trends and risks, and really with a focus on supervisory practices, effective supervisory practices to respond to these trends. And that has included our work on topics such as climate risk, cyber risk, digital innovation, and so on. And then finally, in the cycle, there is our work that we do on implementation, assessment, and support. So firstly, having robust processes to check the consistent and comprehensive implementation of our standards, and then providing support to our members to implement those standards. And this is a cycle with feedback from our risk assessment and our implementation assessment feeding into another round of standard setting and supervisory guidance. That's it in a nutshell, but for more details, let me hand over to the committee chairs, starting with Dieter. Dieter, over to you.
Thank you, Jonathan, and hello, everyone. Good morning, good afternoon, and good evening also from my side. Let me start by saying, and for some of you who have already joined us earlier this week, for instance, during the EXCO dialogue, it's fair to say that in recent years we've come a long way in terms of IAIS, its ability to monitor the key risks and the key trends in the global insurance sector. And with the implementation of our global monitoring exercise, also known as the GME, which, as you know, forms an integral part of the holistic framework, it's also fair to say that we have evolved towards a robust risk assessment framework, which actually builds on data from more than 60 of the largest international active insurance groups worldwide, covering also 45 supervisors. And that enables us actually to cover more than 90% of the global gross written premium. And it's thanks to this robust data gathering that we have laid down a sound foundation for our macroprudential analysis at the IAIS. And these macroprudential analyses allow us to feed an insurance perspective into the assessments and the analyses that are performed at the Financial Stability Board, which then in turn they cover, of course, vulnerabilities and risk assessments of the wider financial system. Now, in general, reporting is a key item for our global monitoring exercise. So next to reporting to the FSB, we also provide for reporting to participating insurers and participating supervisors to give them direct feedback of the data they've provided to us in scope of the GME. And last but not least, we publicly disclose aggregate figures of our global monitoring exercise through our GMAR. We do this on an annual basis with, since last year, also an interim update, which we try to publish in July, and only this year we've published it last week. And this interim update is then followed by a more complete set of findings towards the end of the year when we publish our full GMAR. As such, through all these reporting processes, we try to cover all the major stakeholders within our GME exercise. Now, as the world around us evolves, we also need to continue to refine our risk assessment in scope of the global monitoring exercise. And it's worthwhile mentioning that at the end of this year, we plan to launch a public consultation on a set of auxiliary indicators. Those are indicators which we use to monitor risks and trends. And we are developing indicators on items such as reinsurance, derivatives, credit risk, and mark-to-model assets. So we are continuously developing the indicators that we use in scope of the global monitoring exercise. Now, in the global monitoring exercise, as most of you know, we assess risk both within individual insurance groups, but also risks from a sector-wide perspective. Let us focus a little bit on the latter. The sector-wide teams identified this year are following up those which we have already identified last year. So as such, they remain a priority for insurance and supervisors. And as already highlighted before, this year's themes are risks faced by insurers in light of the current challenging and uncertain macroeconomic environment. By the way, I'm still on the previous slide. Sorry, just to flag that. So the first theme is the risks faced by insurers in light of the current challenging and uncertain macroeconomic environment. And the second theme are the structural shifts in the life insurance sector, such as increased allocation of capital to alternative assets and increased use of cross-border asset-intensive reinsurers. I will come back to those two risk themes later on. Now I would like to still highlight there are two other areas of supervisory priority for IAIS. These include operational resilience, in particular to cyber risk and climate-related risks. On the other hand, in these areas, the IAIS is currently developing operational resilience objectives for supervisors to support insurers within the setup of their operational resilience, which includes cyber resilience. And as in prior years, in terms of climate-related risk, we will try to include an assessment which will appear as a dedicated chapter in our year-end GMAR. Now let's go to our next slide. Here, let me give you a few highlights of the interim findings and our ongoing work from in scope of our GME this year. As mentioned, we published our mid-year GMAR last week, sharing some interim findings, which are based on preliminary data of 2024. So that is data collected up to and including June 2024. These findings could still be subject to some change by the time we have our year-end GMAR, but I think they do provide some first glimpse, some first direction of the results we can expect. In line with last year, you notice that these interim results show overall stability in terms of solvency, liquidity, and profitability of the global insurance sector. We have seen some slight increases compared to last year, and we can still conclude, such as in line with last year, that the solvency and liquidity positions remain strong amongst the participating insurers, which is actually a positive message. Looking ahead, based on the qualitative input we have received from most participating insurers, they do expect further stability in terms of these indicators going forward for the next 2 years. However, some participants have flagged us that a slight deterioration in some of these metrics may be heading towards us, largely due to the uncertainty we still perceive in the future global macroeconomic trajectory, sometimes also in combination with impacts that are expected based on specific circumstances for certain specific insurance groups. Also worthwhile mentioning here is that the participating insurers' aggregate systemic risk scores increased again year-end 2023 after a slight decrease year-end 2022. This is an upward trend that, apart from last year, we have seen in the past few years, with as a key driver the increase in the rise of level 3 asset indicator. This year, we noticed this change was primarily driven by accounting changes. We have indeed seen how, for insurers that report under IFRS, the implementation of IFRS 9 and 17 led to a reclassification of certain assets from amortized cost to fair value. And we are currently conducting further analysis to better understand the impact of these accounting changes. And looking ahead, we are evaluating different options for a more comparable substance-based risk assessment of mark-to-model assets that would be less dependent on their accounting treatment. Also here, the year-end SHIMAR will provide a more detailed assessment of these issues based on the analysis that we still will perform in the scope of this year. So something else to look forward to. Now, as promised, let us zoom into our sector-wide risk assessment, and I think for that we can go to the next slide. As you may remember, the themes for the collective discussion are determined through a review of several inputs, an outcome of several processes, such as the follow-up, of course, of what we did last year, the input that we get through domestic analysis of our members and the contributions they have in scope of that, our input that we get through qualitative input, both via the individual and the sector-wide monitoring, so we get the participants' view on which risk should be prioritized. And we also have our yearly discussion at the level of the IAIS Executive Committee with the CROs. So these inputs all form together important inputs for us to determine these risk themes. And as a first theme, which is in line with last year, we focus on interest rate, liquidity and credit risks in view of the current challenging macroeconomic environment. The global economy has demonstrated strong resilience so far. However, when we look ahead, we have to take into account that growth could still be negatively affected by the prolonged high interest rates, sometimes also high inflation environment, high government debt, and also in combination with the tightening in monetary and or fiscal policies. Additionally, we observe more and more geopolitical tensions, and this has led us to identify certain specific areas of focus. The first area is interest rate risk and liquidity risk. So for instance, we are looking into lapses because we know that in a higher interest rate environment, there could be an increased risk of insurance policy lapses and surrenders, as well as another area where we're looking into our derivative margin calls, which could also lead to potential liquidity pressures. Another area is the area of credit risk. We know that as interest rates increase, this could put pressure on debt sustainability of fixed incomes assets, and this includes sovereign debt and corporate debt. This would, of course, have implications on the insurance sector. We know that they often hold substantial exposure to these type of assets, and it's important for the insurance sector to manage these risks. Also, real estate exposures are on our radar, particularly or primarily commercial real estate. We've seen some commercial real estate markets that have known some stress lately, and we know that insurers' aggregate exposures to commercial real estate remain generally limited. However, we also see that there are outliers. Plus, there is a possibility of second-order effects that could materialize. And in these areas, it's worth flagging that we see how, for instance, the market on securitizations for certain real estate assets is under pressure. So these elements will be under further scrutiny. A third item is geopolitical risk. We know geopolitical risk may have significant implications by disrupting, for instance, global financial stability through channels such as less economic trade, lower market confidence, supply chain disruptions, impact on inflation and interest rates. Now, our focus will, of course, be on how these transmission channels related to geopolitical risk could impact the balance sheet of the insurers. And last but not least, there is the impact of digitalization and artificial intelligence. Here in scope of the GME, we focus on the impact of AI and digitalization linked to the risks we flagged earlier. Let me give you one example. The 2023 banking sector turmoil did demonstrate the speed at which customers can act collectively, also giving us some evidence that social media had an influence on several recent bank runs. So these technological advancements and the link to, for instance, surrender risk for insurers is also a topic that we covered amongst others. Let me move to my last slide, which covers the second theme. And we've been discussing this second theme already a few times this week. So it entails the structural shifts we observe in the life insurance sector. As you probably know, our work here is focused on two topics which are interlinked. First, the impact of the growing exposures in alternative assets. As highlighted before in scope of our GMAR, this trend could bring both certain supervisory concerns as well as some benefits to the investment strategy of insurers in general. In terms of benefits, we see how alternative assets expand the investment opportunities of insurers, expanding the universe of the long-term assets which could fit well with the long-term liabilities of insurers. Of course, as we are supervisors, we focus also on the potential concerns. We have outlined most of those concerns already in our GMAR last year, but allow me to repeat them. So we know there are more discretionary elements in terms of valuation of certain of these assets. There are potential increased liquidity and credit risk. We are looking into hidden leverage. And sometimes there are also particularities linked to transactions with affiliated parties. So all areas which we try to dig in deeper in scope of the GMAR this year. The second topic is the increasing trend of the use of cross-border asset-intensive reinsurance. So this is reinsurance whereby a material part of the insurance investment risk is also transferred to the reinsurer. And this cross-border asset-intensive reinsurance phenomenon has raised some supervisory concerns about knowledge gaps in non-domestic prudential frameworks, highlighted the sometimes limited information exchange related to these particular reinsurance structures. And last but not least, it also pinpointed to concerns regarding conflict of interest within corporate structures. Now, from a financial stability perspective, we are also looking at concentration risks at jurisdictional and reinsurer level, as well as potential herd behavior amongst insurers. Again, a series of aspects which we would like to cover more, and at first high level insight we'll be giving through this year-end's GMAR. Now, as we felt that this topic requires also more detailed analysis, we are also working on an issues paper, which covers both aspects that I mentioned earlier. We intend to publish this issue paper for consultation first half of next year. The paper intends to share more in-depth examples of the steps IAIS and the members are taking to supervise the risks associated with alternative investments and asset-intensive reinsurance. And as part of this, we will try to develop a principle-based classification of alternative assets to support our own and also the IAIS members' analysis in this area. Our work on asset-intensive reinsurers will then try to look at the drivers of these transactions and look at, for instance, jurisdictional approaches to capital, collateral, reserving, and asset valuation. In addition, the work will also look into how current supervisory material is able or not to adequately help the supervisory concerns which I flagged earlier. And in the next step, we will have to check if there would be any potential gaps to address within this supervisory material. So let me pause here and give the floor back to Jonathan. I hope this gave everyone a first glimpse of what we are doing in scope of our GME, and I'm happy to answer any questions that would remain. Thank you. Back to you, Jonathan.
Great. Thank you very much, Dieter. I think that gives a very good sense of the real progress made in the last few years on implementation of the holistic framework. With that, let's open up for questions. I see we have one question from Mary Frances Monroe from the International Institute of International Finance, IIF. Mary Frances, over to you.
very much, Jonathan, and thank you, Dieter, for a very comprehensive overview of the Macroprudential Committee's work. And indeed, your overview answered a number of the questions I have. But let me ask you a bit more about that principles-based classification of alternative assets and how that would be used in practice. And then a second question I have is whether you expect changes to be made to ICP 13, which addresses reinsurance and risk transfer, or the development of additional guidance under ICP 13. Thank you.
Okay, let me try to go a little bit deeper into the details of these two aspects indeed. I mean, one of the reasons that we are setting up an issues paper is because it is effectively, in our view, a good format that would allow us to dive into these topics a little bit more into detail. Now, what can I tell you on the principle-based definition of the alternative assets? First of all, we've seen that different supervisors apply different definitions and sometimes also different treatments of alternative assets. And what we will try to do in scope of the issue papers is to refine, first of all, the proposed definition that we started to develop last year in scope of the GMAR, taking into account, of course, the differences that could exist between jurisdictions and markets. But we will try to check if we can find at least find some common basis or common principles that would help us to fix or to say what constitutes an alternative asset. This work has just been initiated in that respect. I think the main goal here is to help supervisors identify and monitor those asset classes that are becoming increasingly more important on the balance sheet for insurers and help them to develop a sound risk-based supervision that comes along with that. And now on ICP 13, the issue paper will include a gap analysis between first the supervisory concerns that we have identified and the already existing IAIS supervisory material, which includes both ICPs and CONFRAME standards and maybe already some application papers. So we are at the start of this analysis. And the objective of the issue paper in this area is not to already propose some drafting changes to the supervisory material. Instead, the aim is to identify whether the current supervisory material is already able to help us to adequately address some of the supervisory concerns we have identified. And maybe in the next step, of course, we would need to see if there would be a need to make some changes and to further develop some of the supervisory material so as to assist supervisors better in overcoming some challenges. Central to this investigation is, of course, ICP 13 on reinsurance and other forms of risk transfer, but we may also look into some other ICPs that can help us as well in addressing some of those supervisory concerns. So again, here also the work will start, and we'll see where we get. The goal being that we should help, we believe, as much as possible, defining a global level playing field in how certain of these elements are treated by supervisors and assist those supervisors that may need help in some of these, let's be honest, complicated matters. I hope that that answers your question.
Thank you very much, Dieter. That's very helpful.
Good, and I see we have one more question, which is, Dieter, you mentioned a bit about the accounting changes that have been implemented recently and how that's impacted the GME this year. Do you maybe want to talk a little bit more about that and also what further work on this topic is planned?
Of course, I'll try to. Thank you, Jonathan. Now, first of all, I think for some insurers, within our insurance pool, that report, of course, under IFRS, we've seen that the implementation of IFRS 17, in combination sometimes with the delayed implementation of IFRS 9, led to a reclassification of certain assets that were previously valued under amortized cost to valuation under fair value. Because assets whose valuation is based on unobservable inputs, so the so-called mark-to-model assets, are only captured in our level 3 asset indicator category. This reclassification, of course, resulted in a change in our level 3 asset indicator. So what we are doing now is analyzing the overall amount of mark-to-model assets. So we're looking at both assets held at fair value, but also at assets which are held at cost, so as to understand the overall exposure and to see whether that overall exposure remained relatively stable or not. So we will be conducting further analysis to better understand, in the end, the impact of the accounting changes and evaluate our options going forward for a more comparable, substance-based, as I said, risk assessment of these mark-to-model assets. We're aiming to get to a risk assessment which is a bit less dependent on the accounting treatment of the assets. And we're looking into options to either develop an ancillary indicators that may help us to doing that, or by making directly adjustments to the level 3 asset indicator as we use it today. And all of that will, of course, fit into our 3-year methodological review of the methodology that we use. And this review will kick off next year. So the timing for that is ideal to make sure that that the reflection that we will be having on these accounting changes will be taken into account into this review work that we will be conducting.
Great, thank you very much, Dieter. And I don't see any more audience questions. So that means we will give 3 extra minutes to our next speaker, who is Matt Walker, Chair of our Policy Development Committee. Good to see you, Matt. As I mentioned, it's been a busy time for the PDC with a very intensive period of standard setting, of course, in particular the Global Insurance Capital Standard, or ICS, but also other areas like resolution as well. So with that, over to you.
Thank you, Jonathan. I think you said it well. It's been a busy time. I'm sure we will use those extra 3 minutes very wisely. So the PDC, for those of you that aren't familiar, the Policy Development Committee oversees the development and maintenance of the IAIS standards, and together with the IAC, or Implementation and Assessment Committee, which Peter will speak to later, oversees the development of materials to support supervisors in implementing these standards. This does mean that the PDC oversees the policy portion of the IAIS's work on both climate-related risk and DEI, but because both those were already covered in the EXCO dialogue on Tuesday, I'm only going to cover them briefly today. What I would like to touch on more in depth are the latest developments on the ICS, our consultation on recovery and resolution, our next steps on operational resilience, and our market conduct work. But I will go quickly through even those to try to save plenty of time for questions, because as Jonathan said at the outset, this is a new format we're testing to try to give you all more opportunities to ask questions. So turning first to the ICS, we are making good progress towards our goal of finalizing the ICS by the end of this year. We launched our data collection in April. We're asking for volunteer groups to share their data with us by the end of this month. Last month in June, we published details on the 2024 candidate ICS, the basis for this year's data collection. This incorporates a number of changes from the version from last year. This is based on data and feedback we received from throughout the monitoring period from volunteer groups, from colleges of supervisors and stakeholders. And most importantly, it considers the consultation comments we received on last year's consultation on the candidate ICS as a PCR. In parallel to the work on the ICS, the Secretariat is making good progress on their work to assess the comparability of the US developed aggregation method to the ICS under the agreed comparability criteria. If the aggregation method is deemed comparable, it will be considered an outcome equivalent approach for the implementation of the ICS. The IAS remains on track to make a decision on this by the end of the year. As we move towards finalization of the ICS, we're also starting to look further ahead towards implementation. A couple of our initial focuses for implementation, at least at the senior levels of the IAS, are setting an implementation assessment methodology and determining and prioritizing the support we will provide to members in their own implementation. One particular focus that I'm sure is of interest to many people on this call is the data that we will collect for next year. I think there's a consensus at the IAIS that our data needs going forward will be at least less extensive than they have been in the past. We were developing and then monitoring the ICS, but the form and the scope of the data collection still needs to be determined. So that's going to be something we're working through with a high priority over the remainder of the year. To support our implementation efforts, we also, as an initial step, conducted a survey of jurisdictions on how they were planning to implement the ICS. A couple messages from that survey. First, we saw strong commitment from members to the implementation of the ICS. And second, many members had already taken steps to implement their ICS and the ICS in their own regulatory regimes. Because we covered the ICS more in depth on our ICS webinar on June 27th, I won't go into further detail at this point. So I'm going to go to the next slide. Recovery and resolution. So as part of the endorsement of the holistic framework by the FSB in 2022, the IAIS committed to consider the lessons we learned from the holistic framework's implementation. Particularly, we learned we were doing in-depth assessments of now 16 key jurisdictions through the targeted jurisdictional assessments, or TJAs as we call them. Largely in response to the lessons we learned from these TJAs, we recently finished a public consultation on proposed changes to our recovery and resolution standards. These revisions are intended to enhance clarity, improve consistency, and avoid unintended consequences that were identified through our implementation assessment. Beyond the TJAs, another motivation for us with the changes was further aligning our own standards with the FSB's key attributes of effective resolution regimes for financial institutions. For example, the IAIS's standards required resolution plans only for internationally active insurance groups, or IAIGs, where those were deemed necessary by the supervisors. But resolution plans may also be necessary for certain insurers that are not IAIGs. For instance, if a jurisdiction determined that a failure of an insurer operating within their jurisdiction could have a significant impact on their own market. So the proposed standard included broader and clearer minimums for where resolution plans should be in place. The consultation just closed on June 27th, so I don't have any main messages from that to share. We're still in the process of going through the comments. We received 205 comments from 19 stakeholders. We intend to consider these carefully before we finalize proposed changes at the end of this year. Following that, we'll prepare and consult on any necessary updates to the associated supporting material. Next slide, please. Another area of focus for us has been on operational resilience and cyber risk, which is a strategic theme for the IAIS currently. We published an issue paper last year that focused on cyber resilience, IT third-party outsourcing, and business continuity management. That work built on work that was already undertaken by the FSB. As we finished that work, our discussions at PDC were really that this is in a very important area. The risk is seen as increasing. And there was a consensus that our work on operational resilience and cyber risk should not end there. So we took the step of converting our operational resilience task force for the IAIS as a temporary group into a working group, which is meant to be more permanent or at least indefinite. As the next step and the first step for the new working group, we are working towards a consultation on principle-based operational resilience objectives. We plan to launch a consultation on that in the next month. The objectives are outcome focused and aim to provide a sound and consistent foundation to support supervisors in developing and strengthening their approaches towards supervising insurers' operational resilience. They do not set out new requirements. I think they're in line with the feedback we got from stakeholders on the last issue paper. After we finish with the objectives, our next step will be developing a toolkit. This will set out examples of existing and evolving practices demonstrating how the objectives can be achieved. We plan to launch that consultation in the first quarter of next year, and taken together, the objectives and toolkit will form a single application paper. We also continue to share information on challenges and emerging practices related to technology. Petra Hielkema, our fintech champion, covered much of this at the Exco roundtable on Tuesday. Turning to our next slide, please. This is on governance and market conduct. A lot of this was also covered on Tuesday. Jerry Cross, our diversity, equity, inclusion champion, spoke of our DE&I efforts. In brief, our application paper on DE&I governance aspects just closed, while our one on market conduct issues related to DE&I just launched. Daniel Wang, chair of our climate risk steering group, also spoke on that call of our climate work related to the application paper on climate-related conduct issues, including on greenwashing, closed in March, and we're considering the comments we received. Beyond what was covered on Tuesday, our governance working group has continued to work to consider how insurers' remuneration policies and practices can drive good governance outcomes. This work is for members only. It provides really practical, concrete input for supervisors. The Market Conduct Working Group has continued its work to consider forward-looking and outcome-focused approaches to conduct supervision, particularly through the use of data such as conduct indicators and by discussing different approaches to consumer risks and trends analysis. Finally, we continue our engagement with stakeholder groups. The Market Conduct Working Group has met with them earlier in the year, and we're leading up to some higher level meetings in, I believe, August. With that, let me hand back to you, Jonathan. I'm happy to take any questions from the audience.
Great, thank you very much, Matt. Very clear, and I think it's also clear the breadth of work that the PDC's been busy with so far this year, not only, of course, the ICS, but a fair number of other areas as well. So we'll now open up for questions, and I see we have 2 questions from the audience already. One from Mary Francis from the IIF, also one from Robert Neal from APCIA. Let's start with Mary Francis. Mary Francis, over to you.
Thank you. Thank you very much, Jonathan. And thank you, Matt, for a very helpful summary of the quite comprehensive work program of the PDC. I'd like to inquire a bit more about the status of the ICS economic impact assessment and any preliminary findings you have to date, when you expect this assessment to be completed, and how it will be communicated, the results will be communicated to stakeholders, and any plans for stakeholder engagement on this topic. Thank you.
Sure, happy to take that. Maybe I can start by just level setting a bit so everyone's, and I don't know if everyone on the call is familiar with the economic impact assessment. One thing we heard consistently from stakeholders we were developing the ICS is it's a very important project. We heard repeatedly of the impacts it could have on markets, and we at the IAIS really wanted to understand what those impacts were before we finalized the ICS to make sure we were aware of any unintended consequences and give ourselves the opportunity to mitigate those where appropriate. So the economic impact assessment is really our response there. We're focused on 4 areas in particular as we're looking at the impact of the ICS. First, on insurance products offered by IAGs. Some of the feedback we got from stakeholders is that the ICS in particular would be impactful for long-term products with guarantees, and they could create a risk of potential duration gaps. So we're looking at product offerings by IAIGs. Investment policies is another area of focus. Insurers are clearly key investors overall, and particularly in some asset classes. So we'd like to understand how the ICS could affect their investment allocations. And the last 2 areas we're looking at in particular are related, at least in my mind, the business models of the IAIGs and their profitability, as well as their ability to raise capital or debt, which is closely linked to their business models and profitabilities. As we were putting this together, we aimed to consider views from a wide range of stakeholders, not only IAIGs and group-wide supervisors that have been extensively engaged in as we're developing the ICS, but also consumer groups, rating agencies, and other stakeholder groups. A prominent source of feedback we received, which you referred to in your question, was in the 2023 consultation we did on the candidate ICS. We had 34 questions in there on the economic impact assessment to try to understand what its impact would be. On each of those questions, we got over 20 responses, so I think that provides a solid foundation for us to assess the impact. We've already made some changes on the ICS this year in response to that. You see that in the 2024 technical specifications, which had some significant changes from 2023. We will publish the economic impact assessment along with the rest of the ICS package later this year. I think I got to all the parts of your question, but please let me know if I left anything out as I was going through it.
No, not at all. That's very comprehensive, and thank you for those comments.
Thank you.
Great. I think we can go to Robert.
Can you hear me?
Yeah. Thanks, Robert.
Thank you, Jonathan and Matt. Yeah, our question relates to your work on operational resilience and cyber. So thank you for organizing the seminar. A lot of good information. And actually, your report, Matt, has been really helpful. Just wanted to note that the APCIA chairs the GIFIA Cyber Risk Working Group, and we're working with our fellow domestic insurance trades around the globe to keep abreast of domestic and international developments, including the work of the IAIS and the FSB in this space. And we appreciate the opportunity to engage in a dialogue with the Operational Resilience Working Group leaders, as we've done in the past, and we welcome future opportunities and recognize that that's been done in a number of other areas too, for example, AI and workshops that have taken place of late. So we very much appreciate those opportunities and think the dialogue is critical. We would wonder if there's any way that GIFIA can be a resource in your work on operational resilience objectives for supervisors to support insurers' operational resilience, including cyber resilience and the related pending consultation that's been referenced in the recently published 2024 Global Monitoring Exercise Preview. So wanted to make that offer and look forward to again meeting with leaders of that working group and welcome your input. Thank you.
Great.
Yes, thank you, Robert. I think you're right. This is a very important issue. The cyber threat to the industry is only increasing as we have greater surface area for attacks. In other areas, increase the impact of quantum computing and how that could affect current encryption algorithms. There's more outsourcing to third parties and nth parties, and concentration risk is another hot topic. The ORWG provides a platform for supervisors to examine trends and consider emerging and evolved practices in this area. We definitely welcome the GIFIA's and continued engagements with them, as well as a couple areas I can think of. First, I mentioned that we are going out shortly with a consultation on operational resilience objectives, and that we'll follow that up with a consultation on an operational resilience toolkit to help achieve those objectives. One of the objectives in the next month and the toolkit at the start of next year. Definitely would appreciate your thoughts on those, and I would continue to appreciate your input on engagements such as this one. I think we'll have a roundtable on tech and insurance at our annual conference this year in Cape Town. There'll be some more engagement on this and fintech. We would certainly welcome any input from GIFIA members on that.
Great. Thank you very much. So I don't see any more audience questions at the end. So we will hear now, but we'll go on to Peter Braumüller next. But what I think we will also be able to do is, depending on the timing, if anyone has any general questions from the audience at the end, we can come back to that. But for now, let me move on to the update from the Implementation and Assessment Committee, and over to you, Peter, to hear a bit more about the work underway by the IAC, particularly given that these topics of implementation assessment and implementation support are going to take on even greater relevance in our next 5-year strategic plan starting next year. Thanks, Peter.
Thank you very much, Jonathan. Yes, it's more than true. As you have just heard, the supervisory material is still increasing steadily, and therefore it consequently also keeps the ISA busy. So the Implementation and Assessment Committee oversees the IS's work on implementation support, which includes supporting material, implementation assessment, and supervisory capacity building. The IAIS plays a particular role in overseeing the IAIS's work on the topics of financial inclusion and protection gaps. Just refer to the speech by Queen Maxima we heard the day before yesterday. It has been a busy first half of the year in both of those areas. Let me start with financial inclusion. Here, together with our key implementation partner, the Access to Insurance Initiative, A2RI, we are currently updating our application paper on inclusive insurance to reflect changes in the regulatory landscape and the impact of technology since the paper's original publication, which was in 2012. We will consult on the updates of the application paper later this year, and we would very much welcome feedback for those engaged on those topics. On protection gaps, I think we have already heard a lot on that on Tuesday. We are currently taking forward a range of concrete actions following the publication of our call to action report that was issued last November. The report makes it clear that thinking about how to address these gaps is relevant to all supervisors, regardless of mandate, and sets out the actions that insurance supervisors can and should be taking to help narrow national catastrophe protection gap. In particular, it outlines 5 major areas of supervisory activity that can help to narrow net cat protection gaps, underpinned by current examples from IAIS member jurisdictions. Following on from the report, we are continuing to pursue a range of concrete actions across the range of IAIS's core objectives and in collaboration with partners. Firstly, we recently collaborated with the OECD to provide technical input into the G7 high-level framework on public-private insurance programs against natural hazards. Secondly, we are working to incorporate a supervisory perspective into the Work Bank knowledge transfer program. Furthermore, we are supporting the A2RI in their collaboration with the Costa Rican supervisor, Zugeze, and the Global Shield against climate risks to strengthen insurance supervision and foster inclusive insurance markets. And finally, we will focus our 2025 Global Insurance Market Report special topic on natural catastrophe protection gaps and the impact on financial stability. Our members recognize the importance of addressing these protection gaps and the importance of working with a wide range of stakeholders to address the closing of protection gaps. Let me now turn to the implementation assessment activities of the IAC. The IAS's assessment activities aim to demonstrate the implementation of the ICPs across the IAS's full membership. First, with the member assessment program, this is an in-depth assessment of one member's implementation of the IAS's ICPs, comparable to assessments undertaken as part of the IMF World Bank Financial Sector Assessment Program, the so-called FSAS. Currently, a member assessment program is in progress on the Sultanate of Oman's regulation and supervision of the insurance sector. The aim is to finalize the assessment report in mid-2025, with the next planned MAP being in Costa Rica. A second area of activity is thematic peer reviews. In October 2023, we launched the thematic peer review on ICP 16, which is on enterprise risk management for solvency purposes. The outcomes of which will provide illustrative examples and support member jurisdictions in implementing efforts, especially on implementation of risk-based solvency regimes. 67 jurisdictions are participating in the current peer review, which is planned to be finalized in Q3 this year with the delivery of an aggregate report. Currently, the expert team is preparing the draft aggregate report, including illustrative examples to support members' implementation efforts. The IAIS will also continue its program of intensive assessment of implementation in major insurance markets to ensure consistency with our standards. And therefore, we are currently executing a second phase of targeted jurisdictional assessment, TGAs, of the implementation of the holistic framework supervisory material. After we have covered 10 jurisdictions in the first place, now we cover 6 additional IAIS member jurisdictions, and the assessments for the others that were completed last year will be supplemented by the results of those 6. And the 6 jurisdictions currently being assessed are Australia, Bermuda, Italy, Singapore, South Africa, and Spain. And the assessment includes off and on-site components and will result in a public report in 2025. Let me now move to another important area of our work in the IAIS, which refers to capacity building. The IAIS has established 6 forums to provide members with an effective platform for peer-to-peer exchange of views on a range of supervisory topics. At our forums, we also regularly invite stakeholders from the industry and other experts to provide perspectives so as to allow for content-rich discussions and engagement between supervisors and stakeholders on trends impacting the insurance sector. Petra Hilkema, our FinTech champion, updated already on the great work of the FinTech Forum on Tuesday, so I will highlight the work of other forums here. We do have the Supervisory Forum to provide an effective platform for senior supervisors to share insights and discuss insurance supervision from a practical perspective. We also do have the so-called Retirement Income and Pensions Forum, which provides members with a platform for considering developments with regards to pension and retirement income products. The so-called Risk-Based Solvency Implementation Forum supports peer exchange and provides practical guidance to insurance supervisors from EMDE jurisdictions on implementing risk-based solvency regimes. Guidance from this work will be finalized in Q3 and will provide really practical advice on how to implement risk-based supervision, risk-based solvency in EMDE markets. We have received really helpful input across our membership, and therefore I'm confident that this will be a really useful resource. Last but not least, the Financial Crime Forum serves as a platform for experts to share insights and discuss developments in the areas of financial crime, including countering money laundering, terrorist financing, proliferation financing, and fraud in insurance. Forum's overarching goal is to enhance understanding and insight into the impact of financial crime on insurance supervision and tracks developments at the Financial Action Task Force, the FATF. Turning to supervisory capacity building as ever, I would like to thank our friends at the A2RI, the FSI, the IAA and Toronto Center that provide an important role in supporting our work. Together with the A2I and FSI, we have supported regional engagements with supervisors from Latin America, Sub-Saharan Africa, and offshore and Caribbean. Additional engagements are planned in Asia and Latin America. Looking towards the second half of the year, we are working with our implementation partners to deliver a range of training programs. Let me just pick a few. So the FSI IAIS Regulatory and Supervisory Online program called First One, the IAIS A2I Actuarial Skills Training Program, and the IAIS A2I Inclusive Insurance Training Program. And finally, We are also working with the IMF to respond to the growing demand for training on IFRS 17. I think it was already mentioned, the importance of IFRS 17 in many, many countries. Lastly, I want to touch on the IAIS's work on promoting supervisory coordination and information exchange. The IAIS's multilateral memorandum of understanding, the IAIS MMOU, establishes a formal basis for cooperation and information exchange between the signatory authorities regarding the supervision of insurance where cross-border aspects arise. And the MMOU has now already 85 IAIS members as signatories, with efforts to expand the number of signatories in the coming period. Jonathan, as I started again to stress, it was unsurprisingly a busy year again for the IAC, and I look forward to any kind of questions. Back to you, Jonathan.
No, absolutely. Thank you very much, Peter. I think that really highlights the extensive support that's provided to IAIS members in implementing our standards. I'd also like to add my big thanks to all of those implementation partners that you mentioned for their great cooperation and support in advancing our work. Particularly grateful to our colleagues at the Access to Insurance Initiative, the A2II, who some of you will know are busy sort of refreshing their agendas, moving into a new chapter, and I'm sure their reaffirmed mission will be key to continued support, not only on the topic of financial inclusion, but more broadly, this third strategic theme that we highlighted earlier this week around supporting the insurance sector to play its key societal role in building resilience. Perfect. So I see we have a number of questions have come through on the audience channel, so that's very good. And first up, I have a very familiar old colleague from the IAIS days, Norma Alicia Rosas, now with the International Actuarial Association. Norma, good to see you.
Thank you very much. I'm very happy. I would like to ask Peter also. You know, the IAIS and the International Actuarial Association and the Access to Insurance Initiative have been working on actuarial training for a number of years. You know very well, Jonathan, that we are pushing very hard the training in these topics. So I would like to ask Peter, what are the key lessons for this work for the IAIS?
Thank you, Norman. Good to hear you again. Firstly, before I go to the substance of your question, I really want to personally, on behalf of the IAIS, say a big thank you for the IAA for the continued leadership and support, which is extremely helpful for us. And particularly, our members are grateful for the time you and your members dedicate to advancing the profession. And what has become clear is the significant capacity challenges that the sector as a whole faces in a number of jurisdictions. And this is both in terms of having the resources to develop and maintain talent. And we know that supervisors in particular face challenges given the real fight for talent going on. More specifically, insights from jurisdictions that participated in the actuarial skills training led by the A2II jointly with the IA and IAIS reveals three main challenges in my view. And let me also say it goes on successfully since we signed the agreement 2017 in Kuala Lumpur and then renewed it in 2 years ago for another 5 years period. So what are these key lessons? I think first of all, the lack of technical actuarial capacity is a common issue in many jurisdictions, hindering the development of appropriate solvency frameworks. The lack of actuarial capacity hits you at several ICPs, at several standards, and you cannot successfully implement that if there is a really big lack of technical actuarial capacity. Second lesson to be learned, limited availability of data in certain regions hampers the implementation of solvency calculations by insurers and the monitoring of the solvency status by the insurers, by the supervisors, sorry. And the third important lessons we do from the exercise so far is collaboration, clear communication, and stakeholder involvement are crucial for successful implementation of risk-based solvency regimes. And in response to this, as I already briefly mentioned in my presentation, our risk-based solvency implementation forum is finalizing now its guidance on transitioning to risk-based solvency regimes. This is really a remarkable step forward for many, many jurisdictions, and they are eagerly waiting for that. And although the document does not offer a definitive solution of these issues, it provides practical guidance to supervisors based on the experiences of other jurisdictions. And the key lesson from developing is the significance of cooperation with relevant stakeholders, including peer supervisors. So therefore, the risk-based solvency implementation forum will continue to serve as a platform for supervisors to exchange ideas and address challenges related to implementing solvency regimes, including strategies for enhancing actuarial capacity in their markets. So again, just to sum up, a very successful exercise so far. Back to you, Jonathan.
Thank you, Peter. I can only second that. Now I see we also have a question from Mary Francis from the IAF for you, Peter, around the work that we mentioned of the FinTech Forum on an application paper on artificial intelligence. Over to you, Mary Francis.
Thank you very much, Jonathan, and thank you, Peter, for a very thorough overview of the work of your committee. I have a question on the, I'd like to get a bit more detail on your comment regarding the impact of technology on financial inclusion and protection gaps, and how the work that was done and the stakeholder sessions that were conducted on AI have potentially played into that consideration of the impact of technology on financial inclusion and protection gaps. Thank you.
Thank you very much, Mary Francis. We have, I think, heard already quite a lot over the last 2 days on particularly on artificial intelligence, but it's good to look at this, happy to look at this from an implementation assessment committee's lens. So the drafting team received some useful input, I would like to say, now discussing what it means for the drafting of the application paper. And as Petra noted in her remarks just the day before yesterday, the application paper will broadly consider 4 issues. Number 1, governance and accountability, what it means the governance around AI systems. Secondly, the safety, security, and robustness of the use of AI in the insurance security. Thirdly, transparency and explainability in terms of the AI models used for both for policyholders and supervisors. And finally, fourth and finally, fairness, ethics, and redress, which explores the issues faced by policyholders with the roll out of the artificial intelligence. This paper will be published for public consultation in the last quarter of 2024. In terms of the other areas of the work of the forum, the focus this year is on 3 main areas. The first, SupTech. We have launched a survey of forum members on what makes SupTech projects successful and how authorities are looking to embed digitalization of their supervisory processes. Our focus here is moving from an ad hoc assessment of different type of SupTech option and tools to strategic priorities and lessons for the use of SupTech. Learnings from this work will be shared with forum members in presentations and member-only webinars next year. We would then like to broaden this work beyond the forum to other members, possibly including a broader survey and a member note. The second big area on digital assets, which includes crypto, other standard setting bodies like the FSB do considerable work in this area, particularly in relation to financial institutions investing in digital assets. We aim to focus on the unique risks for the insurance sector, and therefore we have started to analyze the global market for insurers that are underwriting digital assets. This is currently still a small market, but we want to understand the developments and any risks posed and being prepared for those. Finally, API open data. This work stream is currently a lower priority as uptake within the insurance sector remains relatively limited, at least for the time being. However, in line with our mandate, we keep monitoring developments on the use of API and open data in the insurance sector, so we don't miss any new trends or risks or important developments. I hope this is a sufficient response to your question, Francis. Back to Jonathan.
Thank you.
Thanks.
Thank you very much, Peter.
Thanks, Peter, Mary Francis, and maybe I can supplement that a bit because it's an interesting question around the the impact of technology and including AI on financial inclusion. And I would say I think the jury is still a little bit out on that. To be honest, it's interesting. I know in the sort of engagements that we've had around the AI application paper, which we had one consultation primarily with consumer groups, one primarily with industry stakeholders, and it was quite interesting the different responses we got in those different workshops. I mean, on the one hand, I think it is clear that technology and AI can really present some major opportunities in terms of not only improving the back office side and customer service side, but possibly increasingly over time, also helping with the efficiency of underwriting, certainly claims handling, and possibly also distribution channels as well. And so to the extent that those changes and those efficiencies help bring down costs and open up the market to customers who were previously maybe could not be commercially serviced, that's a positive. On the other hand, on the flip side, we also heard from consumer groups a number of concerns about the potential for the use of technology and big data and in combination with AI to sort of increase the granularity of risk pricing, possibly undermining the risk pooling that is part of traditional insurance, possibly resulting in a case where that could lead to greater exclusion of higher risk or vulnerable consumers. So it is I think it's a bit of an open question whether on the one hand a combination, having more data and more capacity to process that data can help reduce the uncertainty premium in pricing and therefore could increase inclusion. On the other hand, some worries about what it might mean for exclusion of high-risk customers and how you address that. So all of that, I think, is going to make for a very interesting discussion in our work ahead on this topic, certainly from a consumer perspective. I'll go now to a third question for Peter. This is actually a question that we received during the EXCO dialogue on Tuesday that we didn't have time to get to on that day, and it is also relates to the topic of technology and the impact of that. It's from Peter Kochenberger, visiting professor of law at the Southern University Law Center. And I'll read out the question. It says, preventing or avoiding bias was mentioned several times during the panel discussion on artificial intelligence yesterday. And bias can mean a variety of things. Are there, including avoiding historical bias, for example, racial or ethnic discrimination, is the view that these historical biases should be included as an essential element of preventing or avoiding bias? I correct myself, that was actually a question from yesterday's panel on artificial intelligence. And I'll hand over to Peter to give a little bit of a sense of how we're looking at that topic. Thanks, Peter.
Thank you, Jonathan. First, my apologies that I was unable to attend yesterday's interesting discussion on the issue. But let me tackle the question from both our AI application paper and also connected to our draft application paper on how to achieve fair treatment for diverse customers, which is currently out for public consultation. So again, invitation to our stakeholders to also give us your input on this paper. The AI paper itself will look at the importance of fairness by design. So generally, supervisors take an approach that AI systems that are harmful or abusive, treat customers unfairly, or do not respect fundamental rights, including the right of non-discrimination, should not be brought to the market. And it is of utmost importance that the use of AI systems does not diminish the protection of fundamental rights, including this important right of non-discrimination. And by the way, the ICPs are also very clear that insurers should not engage in any illegal practices. Our current consultation on how to achieve fair treatment of diverse customers also discusses biases and how they may be part of an insurer's business culture and operations throughout the product lifecycle and lead to unintentionally discriminatory practices, policies, pricing that negatively impact diverse consumers. Some of these recommendations are that insurers should ensure that evolving technologies like AI systems do not embed unfair outcomes for diverse consumers through embedding bias, and in the context of risk-based pricing, that insurers should consider whether the use of certain measures of risk profile are based on unfair biases or stereotyping, outdated data, or similar issues. And we are keen, of course, to hear from stakeholder views on those issues in the current public consultation. I hope I could give some insight from an IC perspective. Thank you, Jonathan. Back to you.
Great, excellent. Thanks very much, Peter. Good. So I did mention that we, if we have time, we should be able to come back for some other questions for other committee chairs, and we have one here for Dieter. Thank you very much for the question from Elizabeth Jacobs, E3G. And the question is there any additional information on the scope and shape of the deep dive on Nat Cat and financial stability risks for next year? What might be the key areas of focus and what type of data collection might support this work? So over to you, Dieter, on that.
Thank you, Jonathan, and thank you for the question. It's not an easy one. It's work that we are still conducting, that we have initiated. So just maybe as a quick reminder, when we have a special topic GMAR, the aim really is to zoom into a specific topic, to take the time to analyze it a little bit more in depth. That allows us to go beyond what a regular GMAR offers us. So we've had, for instance, special topics on climate risk already, but then focused on transition risk. We've also had a special topic on cyber underwriting risk. And indeed, for next year, we try to cover natural protection gaps, and the link with financial stability. So what we will try to do is try to assess whether these protection gaps could cause financial stability impacts. So we know, for instance, that uninsured losses could cause certain disruptions, be it to real estate values, be it to agriculture, be it to public resources. And the question is, could that cause financial stability issues? So we will be looking into that. We will be looking into mitigation strategies that are used by insurers and supervisors to respond to that. We'll be looking into ways in how to monitor that. So data will be key. So usually with a GMAR special topic, we try to collect data through the individual insurers that participate, through the supervisors that participate. But we are also open to look into other data sources, and in particular for this topic, I think that could indeed be needed and necessary, because if you want to make assessments, for instance, on the magnitude of protection gaps, on the potential financial stability impacts, etc., I think we need to go beyond the data that we have today. And so we have started to look into that in scope of this year's data collection of the global monitoring exercise, but we will need to go beyond that probably next year. And hopefully, on the basis of the extra information that we can gather, we can have this deeper dive analysis, and we can shed some light on the big question of how these protection gaps could cause or not financial stability risk. So that's exciting work, I would say, to look forward to.
Yeah, very much so. An important topic as well. So next up, we have a question for Matt, Chair of the PDC, and this comes from Angus Scorgie, Head of Prudential Regulation and International Affairs at Insurance Europe. It's a little bit of a pre-taste of some of the consultation feedback I think we'll be getting on the recovery and resolution standards and the changes to those standards. So I'll read out the question. In relation to the changes to ICP 12 and ICP 16, could you please provide some more information on the lessons learnt from the targeted jurisdictional assessments which informed the decision to increase the minimum requirements for recovery and resolution planning at the level of the insurance core principles? We, being Insurance Europe, consider the existing ICP requirements to be sufficient and are concerned that the broadening of minimum requirements in this area will result in additional operational and reporting burdens which are not proportionate to the level of systemic risk posed by those insurers which will be in scope of the recovery and resolution planning requirements in the future. So over to you.
John. Yeah, I thought I got off a little light there on the PDC questions, but I was prepared for some questions on resolution and recovery because, as I indicated, that's an important issue that we're going to be thinking through the rest of the year. So first, let me just thank you for your feedback, and I hope that's in a consultation comment as well, because we will carefully consider those over the remainder of the year. As far as our motivation with the proposal, I personally at least think of it in two different buckets for these resolution and recovery standards. For the IAIGs, a lot of our motivation was just clarifying the as necessary language. So I think our past standards there we saw in the targeted jurisdictional assessments weren't very specific on where these were necessary. I think one consistent theme in our first years of implementation, I remember because I helped with the holistic framework coming up with that and sat on MPC as we were doing the collective discussions. It was a consistent theme that we'd keep coming back to whether resolution plans were necessary and whether they were in place in the early years. So we really wanted to provide some more clarity on that. It is ultimately a jurisdiction's decision on whether a resolution plan should be in place. We hope to enhance the consistency around the world and provide some clarity there. For non-IIGs, really what part of our motivation there was a potential gap. The standards spoke of resolution plans being in place where those were deemed necessary. For non-IIGs, it referred to evaluating prospectively their how they would fare in a resolution where that was deemed necessary. So we had a lot of discussion at least the PDC on how exactly those differed and plan versus planning, but we didn't want there to be a gap for any insurer that was assessed to be systemically important under the existing requirements in ICP 24.3, I think, where in jurisdictions were supposed to do an assessment of the systemic risk of individual firms. If we thought if jurisdictions did assess there to be systemic risk at a particular firm, a resolution plan should be in place at a minimum, and that was already within the FSB's key attributes. These are open issues going into the rest of the year, so your feedback is very timely. We asked a question on both aspects of this. For IIGs, we asked a question about potentially whether there should be a presumption on resolution plans being in place for IIGs to help further enhance clarity and consistency. And then for non-IIGs, we asked about proportionality and what should be the minimum expectations there. I hope that covers your comments. We do appreciate the feedback.
Very good. Thanks, Matt. So I kind of watch this space a bit there as we consider the consultation feedback. But thanks very much for that very clear explanation of the driving factors behind some of the proposed changes. Before we move on, I see we have one quick question from Dave Snyder from APCIA, also on behalf of JAFIA. Thank you, Dave, for pointing out that JAFIA has been actively involved in the work on protection gaps, artificial intelligence, and the DE&I discussions that we've been having. And the question was that beyond the public consultations that we are busy with on those three topics, will there be additional opportunities for engagement on these issues, considering that the roundtables that we've had at our in-person events have been very valuable? So first of all, thank you very much to JAFIA, always for the excellent and constructive contributions to our work. I have to say, and in line with the revised stakeholder engagement and consultation policy, the SECP that we put out last year, we have been certainly putting a lot more effort into the frequency and having meaningful engagement throughout the process. So you will have been aware, for instance, the sort of webinars that we have that accompany our consultations to give some flavor of what informed the different proposals. So we have one next week on the diversity, equity, inclusion paper from the Market Conduct Working Group. We also have encouraged that at our working group and task force level that we have, actively look for opportunities for engagement with range of stakeholders. So you will have seen a number of invitations from the different working group and task force chairs to have engagements with those groups on specific topics. And the last point that you raise on the roundtables, I'm glad you raised that. We did get certainly positive feedback on using roundtables for kind of more in-depth and smaller group discussion on specific topics at our events. And I'm happy to say that we certainly will plan to have roundtables on key topics at our next in-person event in Cape Town in December. I'm just checking. No more audience questions at this point. So thank you very much, though. Those were very, very interesting questions that we received. And with that, I'm going to sort of wrap up today's session. Thank you, everyone, for joining. We hope you found it informative and engaging. You will get a survey to fill out on your feedback, which should just take 30 seconds to complete. Thank you. It's been our first virtual global seminar. I think we've tried very hard to give it as an in-person feel as possible, and make sure that we have plenty of time for engagement. So over the last few days, we've had dialogue with our ExCo leadership, our ExCo champions, our committee chairs. We've been able to look in depth in two key topics, obviously the asset side of investments and the increased use of asset-intensive reinsurance, and the very topical issue of artificial intelligence in the insurance sector. I'm also very pleased that we were able to kick off our virtual global seminar with opening remarks from Her Majesty Queen Maxima of Netherlands in her capacity as UN Secretary General's Special Advocate on Finance for Development. It was very difficult to top an address from the Prime Minister of Japan in Tokyo, but I think with the address from Her Majesty, we're doing well. But on a more serious note, it was wonderful to have had that support and that encouragement from Her Majesty to further develop the IAIS's work on financial inclusion, to put consumers at the center of this work, and a timely reminder of the real benefits of the steps we will take in our next 5-year strategic plan to focus on the role that the global insurance sector has to play in making societies more resilient. So if you've missed any of these sessions, or you want to revisit one, the video replays are already available on YouTube, which you can access through our LinkedIn channel, and will be available on our website tomorrow. Lastly, of course, to turn to the future and the next opportunity for us to come together, which I'm very happy about. It's our in-person annual conference, which will take place in my old hometown of Cape Town on 5 and 6 December. We will open registration in August. Cape Town is a popular destination, so I would encourage you to book early. And I do hope to see as many of you as possible there, and to celebrate a very good and busy year. So thank you.